to BloombergQuint. A new year, a new budget coming up, but unfortunately also a new wave of COVID infections. All of that muddies the waters in terms of understanding the economy and also what the priorities for the budget should be. Joining us to help us sort our thoughts out, Sajjid Chinoy, Chief India Economist at JPMorgan. Sajjid, thanks so much for taking the time, as always, to speak to us.
Morning, Ira. Good to be here.
Sajjid, you have a note out, and I'm going to start with that because that helps sort of clear out the thinking on the economy. I think we got the first advance estimates, and we were all watching for two things. One, in terms of level, whether we are back at pre-pandemic levels. But I think you've taken pains to explain that it's not just levels, but also trend that we should map it to. As things stand right now, where are we on those two metrics?
Yeah, thanks, Ira. So, I think there's an old joke that if the speedometer isn't working, you don't know whether to accelerate or to brake. And I think in COVID times, it's really important for all of us to agree on what speedometer to look at. Year-on-year growth rates at the best of times are deceptive because they talk about the accumulation over 4 quarters. So more and more countries are just moving to a quarterly momentum path. What is the quarter-on-quarter annualized growth rate? Are we growing at 5% or 6% or 7%? And I think more and more, given repeated waves, to get an understanding of the economy, we should start focusing on the sequential momentum of growth. That tells us what speed we're driving at the moment, which is important. The second point, as you alluded to, is levels. We need to know how far to go and how far we are from our destination. And so I keep going back to the pre-pandemic path. Let's assume the economy is going to go at 6 or 6.5% absent the pandemic. So we can map out a level of GDP every quarter and keep asking ourselves, how far are we from that pre-pandemic path? Because ultimately, that's what matters for job creation, as we'll discuss later. So I think what the advanced estimates tell us is, in the last quarter, we were back at the pre-pandemic level. We were 100 in March of 2020. In September, we're back at 100. And to be fair, October, November, December, we're still growing at 3 or 4%. I would argue it's not as buoyant and strong as some people made out to be in the month of October. If you look at a monthly frequency, you'll see October was very strong, but November gave back a lot of those gains, suggesting that October was much more kind of pent-up, festival, concentrated demand. But despite that, I think October, November, December will still see a 3 to 4% sequential increase in levels. January to March has become much more uncertain because of Omicron. But if you just stick by the advanced estimate, and if we grow at 9.2%, I would argue there's some downside risk to that. We'll still be about 6% below the pre-pandemic path. And we have to ask ourselves that every 2 quarters. A year from now, is that gap from 6% getting lower? How much lower? How quickly will we asymptote towards that path? One final point I'll make just in terms of year-on-year growth rates for FY23. Because of these large potholes and the worries that I spoke about, a year-on-year growth rate for next year will offer more noise than signal. And here's a simple example. The consensus estimate for FY23 is about 7.6% on the back of a 9% growth this year. Well, that's essentially only corresponds to a 4% annualized growth momentum through the year. So if the economy grows at 4% through the year, we still have a 7.6% number, right? To have 7% growth through the year, that full year number needs to print at 9.3 or 9.4. So again, what I would urge and plead everyone to do is abandon year-on-year growth rates. Let's focus on sequential momentum. Let's focus on distance from the pre-pandemic path.
Beyond the headline, so I think we've all sort of focused on the consumption side. It's important to try and understand how that is playing out. You also, in your note, then go on to look at consumption of goods versus services.
Yes.
Can you help us understand why you see that as important?
That's just a qualitative barometer to help us whether we're just coming back to pre-pandemic levels or how we're growing beyond that. Because if you look at the differential speeds, goods were back, and I'm using IP as the broad barometer of goods, were back at pre-pandemic levels in March or April, right? And services have taken much longer to get back. Now, the question is, if the growth in the last few months or the next few months is driven by goods who've already reached the 100 level, that's really encouraging because that tells you there's life beyond the pre-pandemic level. If it's driven largely by services reopening and getting back to 100, then there are limits to that process. And any upsurge will be contained. So I think the second kind of qualitative metric to keep asking every month or every quarter is this acceleration or is the momentum being driven by goods or by services? Thus far, unfortunately, IP seems to have got stuck around the 101 mark for the last few months, suggesting there's a plateauing out there. And much of the momentum that we've seen in the last few months is services. Again, I think the IP number that comes out this week, I think there's an expectation here that month on month that may contract again. So we've got to be mindful of what's driving growth, because that would be a good way to prognosticate the future.
And also what's driving consumption, right, at a broader level. Whether it is what was happening in the pre-pandemic years where there was leverage, etc., which was driving drawdown of savings, which was driving consumption. In the post-pandemic time, do you think there's any sort of expectation of that trend continuing? If not, then do we have to start focusing on jobs and income growth, which we'll come to in a minute?
Exactly. So we had this conversation, I think, in August,
Yes.
C plus I plus G plus X.
Yes.
That was a kind of more hypothesis driven. I think now there's much more data confirming what we had said then, that let's not look towards C and I, let's look towards G and X as being the primary drivers of growth in the near term. I think the consumption story, as you pointed out, was a lot of it was driven by debt and leverage pre-pandemic. So really there are two underpinnings to sustain consumption growth. One is either job creation, or the second is what's happening around the world, which is excess savings, that a lot of households forced to build up savings. And so even though job creation will take time, we can run down these savings over the next year or two to buy time. That may be true in advanced economies, but it's not true in many emerging markets. Now, there's no direct data on this. So what we do in the note is to backwork this. And I call this the tyranny of macroeconomic identities, that ultimately, these identities have to meet. Essentially, the current account deficit is simply the investment savings gap of the economy. And you can break that down into the public sector and the private sector investment savings gap. Now, the public sector gap is simply the public sector borrowing requirement once you adjust for arrear payments and asset sales. So we have that number, we have the current account deficit number, which means we can back out what the private sector investment savings gap is. And what that simple exercise shows is that there was a big increase in the private sector savings investment gap by about 6 percentage points last year. By the end of this year, that's pretty much gone. We're just about 1.5% higher than pre-pandemic levels. And because that is both the household sector and the corporate sector, my sense is a lot of those excess savings is lying with the corporate sector, who have seen strong record profits, sitting on large cash balances, haven't seen much investment. So it's not lying with the household sector. So I think, and the RBI data pointed to this. If you remember, about a year ago, the RBI came out with some household financial savings data to show that much of the increase in financial savings in the first quarter after the lockdown had been run down in the next 2 quarters. So this is just to be realistic here, that we don't have this big pool of excess savings that advanced economies have, which is why we'll have to look for sustained job creation as a prerequisite to sustainable consumption growth.
And that's not showing up yet, right? I mean, whether you look at the Manrega numbers or you look at, the agriculture employment numbers, but Manrega being the highest frequency seems to suggest that there is still scarring in that segment.
That's right. That's right. So I think if you look, closely, what was disappointing for me was the services economy has opened up meaningfully in the last 3-4 months. And demand for Manrega in December 2021 was pretty much the same as December 2020, about 24.7 million. And this is, 35 to 40% higher than a typical December. So we haven't seen the reduction in Manrega commensurate with in opening up in the services economy as was hoped. That, as services open up, a lot of these jobs will come back. Now, to be fair, the aggregate job numbers that CMI reports have ticked up a little bit in the last few months. Right. So again, if you go back to what is the total employed population in India in absolute terms, we've begun to slowly approach the level of March. But what this misses is that, remember, the working age population is on its pre-pandemic path. Yes. So the economy may not be on its pre-pandemic path, but the working age population is. So there are all these people who've entered the workforce in the last 2 years. And so our sense is the employment to population ratio, which is what we need to look at just in the US. Don't be fooled by unemployment rates. Labor force participation around the world has fallen, as it has in the US. So to get a holistic picture, the focus must be employment to population. And that was 38% in India pre-pandemic. That's now come down to between 35 and 36. It was 36% in December. That gap is essentially the fact that all of these people, the working age population has increased. we will need, between 20 and 22 million jobs that need to be created, to get that ratio back up to 38%. So really, I keep saying, let's not hold out hope for private consumption, recognizing this backdrop that there isn't much excess savings, the labor market's taking time to heal. We really need to look for other growth drivers. Hopefully, those will create jobs. It's the jobs and the income certainty that will hopefully propel consumption, and that will take time to recover.
A quick follow-up question on the job side. What do you think is happening that is preventing that sort of scarring from healing to some extent? Is there a change in the nature of sort of jobs that are coming into the market? What's your sense of what's changing on the employment side?
It's an excellent question, Ira. And I think the early hypothesis is, when we talk about this uneven recovery, what we've seen is that the formal sector increased its footprint quite sharply during the pandemic at the expense of the informal sector. But remember, the informal sector is much more labor intensive, right? The formal sector is much more capital intensive. So essentially what's happened is, because of this forced transition from informal to formal that COVID has triggered, output in India has become more capital intensive, right? And so you can produce the same level of output using fewer workers. I'm being simplistic here just to make the point that as the capital labor ratio improves. Now, there are many nuances to this. Moving to, for an activity moves to the formal sector, in the medium term, this will be productivity enhancing. There are economies of scale. Large firms can compete better in global markets. All of that is true. But in the near term, the transition has to be managed, because the near term implication is that you will have job losses because activity has become more capital intensive. There's one other element to consumption, just to bring up very quickly. We speak about the consumption pie, but the division between urban and rural consumption, there was a belief that rural consumption would remain very strong because we've had 2 strong monsoons and agricultural production has been high. Some signs, the RBI in its latest bulletin speaks about some softness in rural consumption. I think part of that can be attributed, to what I call the terms of trade effect, both the external terms of trade and the internal terms of trade. So with oil prices moving up, fertilizer prices moving up, input costs for farmers have gone up. And so their margins have come under pressure. This in a way is because of higher global commodity prices, and that's impinging on income growth. And then if you look at food to non-food inflation, the internal terms of trade effect, over the last 9-10 months, non-food prices have grown faster than food prices. So whatever income you have, your purchasing power as a farmer is now lower. So I think it's the combination of both these terms of trade effects that may be contributing to some softness in agricultural consumption in particular.
So if one goes back to the equation, so consumption, we have to be slightly sort of cautious on any outsized expectations of a recovery there. Exports, are doing well for us, but there's only so much perhaps they can do. Private investment does not look like there's any immediate signs of it picking up at the aggregate in a meaningful way.
That's right. I think, again, private investment, the good news is balance sheets are looking better and better, right? So people are primed for the next cycle. But I go back to utilization rates. That ultimately, with so much uncertainty, so you either require, lots of animal spirits, so people can look through near-term utilization and say the world is going to be such a buoyant place over the next 3 years that I need to anticipate utilization at 80-85%. But when you're plagued with so much uncertainty globally about repeated waves and lockdowns, then you just go by, where utilization and demand is. And I think with utilization at 60-65%, it will take some time. We've got to be realistic about private investment, which is why if you look at new project announcements of the last few quarters, they're still muted. So again, we need to be realistic here that both private consumption and private investment will take time to heal, which then increases the burden sharing or the other drivers of demand.
Which is government spending, which brings us to where we are and heading into the budget as well. So fiscal policy still has a large sort of burden to shoulder at this stage. Monetary policy perhaps less so.
Yes. So I'll just take 30 seconds to say, I think we shouldn't discount the role of exports. Okay. That we just think 2022 is going to be different from the last crisis globally, in that private sector balance sheets around the world are very strong. So the opposite is true there. They've got so much fiscal support and so much excess saving that in the US, it's $2.5 trillion. So our global economists actually are very buoyant about growth in 2022. In fact, in October to December quarter, global growth was tracking 6% in real terms, the highest ever, barring the lockdown periods. And there was 6% inflation. So you had 12% nominal GDP growth. So once the near-term Omicron, hopefully it's short and sharp, is out of the way, we still have strong expectations for advanced economy growth for 2022. So I think we shouldn't completely rule out the role of exports, not just manufacturing, but services. That but what COVID has done is accelerated the transition to IT. India's IT sector is very well positioned to grab that opportunity. And we're seeing that in the data. If you look at the last 3-4 quarters, you look at the services, net services export numbers and the invisibles, they've been rising sharply. So I still think exports can and will have a role to play in 2022, but that will need to be complemented by fiscal policy. I think the difference from when we spoke last time, Ira, was we spoke about CI, G, and X. The constraints were much less. Remember, in August, you had strong global growth, but financial conditions were very benign, and global commodity prices were still relatively muted. Now, with financial conditions tightening, the Fed's going to be, has made a very hawkish pivot. We expect rate hikes to start from March, 3 rate hikes this year. They will let their balance sheet roll off at some point mid-year onwards. And so fiscal and monetary were complements for the last 2 years in India, helping each other to mitigate the damage. But by year 3, with inflation still above 5%, inflation expectations have hardened by about 200 basis points. And the current account has now moved from the 1% handle to the 2.5% handle, right? So in fact, October to December, we see the largest quarterly current account deficit in 8 years. Now, I don't think that's going to sustain. I think we'll be back to the 2% handle. But it just means some of the external constraints are increasing. The global economy is not as benign for emerging markets as it was 6 or 9 months ago, right? And therefore, I think policy will have to be more selective. I think fiscal and policy will gradually have to become substitutes from complements. My own sense is, because this is an uneven recovery, fiscal policy is far better positioned to offer targeted support and do the capex. Monetary will therefore gradually have to normalize.
But in terms of, say, the space vis-a-vis what is the stated path of, the fiscal deficit reduction, one would assume that the government would follow that path, or you think there is enough rationale to veer away from that, keep the fiscal deficit higher, even compared to what they projected last year?
I would not go down that path. I would think that the path itself that's been laid out is quite a gradual one. And I think, I think it's important to print the deficit close to 6.8% this year. We're already seeing, because of what's happening globally, financial conditions in India have tightened. 10-year bonds are up by 15-20 basis points over the last month. What you don't want is to increase fiscal risk premium. So if the idea is to have a more gradual path, I think the fiscal marksmanship should be good. And I think it'll be good to hit the 6.8 or come very close to that number this year, but then have a 0.5% or so consolidation for the next year at least. That part that was envisaged was 0.5, 0.6%, every consolidation every year. I think this should not be linear. I think in the first couple of years, it should be 0.5%. Then when you're sure about the recovery, you can increase the pace of consolidation. There'll be a temptation here from analysts to say, tax collections were so strong last year. Let's budget that same buoyancy this year and surprise bond markets and push 10-year yields down and over consolidate. I think that will be too much of a gamble given uncertainty. Tax collections truly are impressive, but part of that, I think, is activity moving, as we discussed, from informal to formal.
Yeah.
Now, next year, hopefully, if there are no further waves and the informal economy begins to recover, which is needed for job creation, some of that activity might peel away from the formal sector, move to the informal sector, and that will mean that tax to GDP actually slightly lower next year, which is not a bad thing if it's accompanied by higher job creation.
Okay, so even if they were to say, target consolidation of say, 0.5 percentage points, even within that, you're saying there's enough room to maneuver fiscal policy in a way to address the concerns that we are facing right now. So, for instance, if I, speak about Manrega, I think this year, there was allocation was clearly not adequate, and then they, up the budget towards the later half of the year. But that seems to add uncertainty to the ability to provide jobs. Would you suggest that at this stage in the next budget, there should be upfront strong allocation to take care of some of these concerns?
And yes, I do. And I think there is space for that because I think composition will matter both on the revenue side and the expenditure side. And there seems to be a natural path of how to achieve the consolidation while keeping certain elements of spending strong. So firstly, on the revenue side, the strong tax collections will help offset the undershooting of privatization and disinvestment proceeds. Right? But again, I know I want like a broken record. Some of the privatization that if it doesn't happen this year, like LIC, really needs to happen next year. So the revenue side squares off, but the composition is different. Next year, you could see lower tax to GDP if this buoyancy doesn't, but then you see higher non-tax to GDP, higher privatization proceeds. Now, the expenditure side, the key this year is actually the subsidy bill is much higher.
Yes.
So last year, the subsidy bill was about 3.5% of GDP. What was budgeted was about 1.5%, 1.4%. Right? It's tracking 2.5%. And for good reason. I mean, part of this is because food subsidy bill is higher. I think of this as being kind of the quasi-income support after the second wave, right? And so it's in-kind support, which was needed to parts of the economy. But let's hope and pray that there is no repeat of that, which means that you've got about 1% of GDP in higher subsidies. They're both food and fertilizer, I might add.
Yes.
Fertilizer subsidies are higher, there are arrear payments. So that cleanup has happened. But if we don't need more support next year, then you should have a percent of GDP lower subsidies on the expenditure side next year.
Okay.
So if you have a percent of lower GDP in subsidies, 0.5% of that can be used to bring the deficit down, and 0.5% of that can be used to bolster other parts of spending. So you keep NREGA a little bit higher. CapEx this year increased very impressively. It went from 1.6 to 2.2% of GDP. Yeah. Now, 2.2 was supposed to go to 2.4 or 2.5. I think it's really important CapEx expenditure, the center and states pick up. We can talk about that.
Yeah.
But next year, maintain that allocation for CapEx. So I think it doesn't have to be very complicated here. The revenue side can be what it is with a rotation away from taxes and towards higher disinvestments. The expenditure side, as you should, as things become normal, reduce the subsidy bill, put those resources into automatic stabilizers like NREGA, but more importantly, into capital expenditure. So that engine keeps moving for the next year or two.
Two questions, Sajjid. One, to your mind, there is no argument, or is there an argument at this stage at all about larger quantum of, say, redistributive policies, if I may not be using the term accurately, but more sort of stabilizers, whether it's a program additional to NREGA or something else, because there is a lot of concern about this inequality that has emerged out of the pandemic, and the government's thinking, at least to my understanding, is that we will address that through a capex cycle, which will create jobs and hence income, etc. Is there any argument on the other side that you increase transfers in some way or the other?
I would argue by year 3, this has to come down to job creation, because I certainly think there should be automatic stabilizers. So if you have another shock, you should increase food grain support, and NREGA should be well funded. But I think now the point has come is if we want to boost consumption, you have to give people income certainty. So giving transfers for 3 months or 6 months won't solve that problem that they will go out and spend. Precautionary savings will go up, there's uncertainty. The best way, I think, to mitigate household uncertainty, protect and preserve livelihoods is job creation. Now, easier said than done. It's not easy to create jobs. And so all we're asking for is catalysts. That if you do another 0.5%, 1% of CapEx spending, the states are really lagging on CapEx this year. They really need to up their game. I think it's be important for the center and states to come together and have a coordinated, 2-year plan. What projects do we pick? How do we execute this? What is the center's role? What's the state's role? Because that does 2 things. One is it keeps demand high. Construction creates jobs, and these are precisely the jobs that we want to create. You want the lower end of the pyramid. Those are the jobs you want to create. But then over time, if public capex is high, you will hopefully slowly crowd in private investment, because then cement utilization goes up, steel utilization goes up. If people have visibility on where the government is going to spend over the next 3 years, then they can plan. And then you create some kind of private investment, and that creates jobs. So it's all about trying to create a little bit of a virtuous cycle. Not easy to create jobs, but I think the only thing we can do now is a big counter-cyclical construction push within the fiscal constraints that exist.
Why is so the state's capex, but even the center capex, it's flattened out a little bit, right, in terms of actual spend in the recent month? What's the story there according to you?
Yeah, it is. The first 6 months were quite strong. Till October, you were still tracking about 27% over last year. Remember, the budgeted number is 30%, but both October and November have been quite weak. I think the government has said something that they will meet their capex target, but the asking rate is high. So I think it's really important, even at the centers level, December, January, February, March, we get that renewed capex push and that flows into next year. Now, I understand that it's not always easy to spend money, especially on infrastructure projects. You've got land acquisition, regulatory issues, projects have to be assigned. And I also know that the base is higher. Remember, capex used to be 1.6% of GDP. It's moved up to 2.2. So with every year, incremental spending will have more execution challenges. But if there's one thing we have to go into mission mode about, that's it. That over the next 24 months, that has to be the foremost priority at the center and state level. A coordinated infrastructure push to create those jobs. But you're right, we're lagging a little bit at the central level. We're lagging a lot at the state level. So, if you look at November data for 18 states, compared to 2019 level, their budgeted number was something like 70% higher. We're only about 10 or 15% higher. So we really need for state capex spending to pick up.
State capex is not a story about inadequate transfers or uncertainty about transfers from the center, is it? Because I think the center's been trying to upfront some of that transfer. Surely money is not the aspect there.
I think this year you're exactly right, because a lot of that was front loaded. I think it's again execution challenges, and to be fair, states have to are on the front lines here. So April, May, June was dealing with Delta. Now again in January you've got waves. So I can understand why execution is hard. But let's look forward. We have to up the run rates over here. One other thing, when I talk about infrastructure, I don't just mean physical infrastructure, right? Health and education are key. So because those are crucial, as we know from the pandemic. I mean, education, we can have a whole discussion on remedial education, right? Let's not even get into what's going to happen to human capital when children, grades 1 to 6 have missed 2 years of schooling. So there's a huge chunk of planning and thinking and spending that will have to happen on health and education. And guess what? That creates a lot of service jobs. So I think that has to be the mindset over the next couple of years.
Okay, Sajjid, just two more questions. One, I know we've toyed with this idea over the years, once or twice. It never sort of fructifies. This conversation around incentives for jobs, sort of job-linked incentive schemes. Is there any thinking that suggests that we should go in that direction, think in that direction?
So when you say job-linked incentives, as in
for investment.
Oh yeah. So there will be incentives if you hire so many people.
Yes. Yes.
I think in emerging markets where the data is hard to monitor, I'm a bit wary about so much micro management and government intervention, because you can lead to all kinds of distortions. Ultimately, what you want to do is level the playing field. We certainly want to ensure that health education means labor productivity in the medium term goes up. We certainly want to take away any draconian labor laws which push up the relative cost of labor vis-a-vis capital. We don't want to subsidize capital by doing things like accelerated depreciation. So any of the distortions that raise the relative price of labor compared to capital should be done away with. But once you've leveled the playing field, I just believe that it's the entrepreneurial energy that's best positioned to decide what the right capital labor mix should be.
Okay, fair enough. Last question, Sajjid, more sort of market-driven. So given the path of fiscal deficit that we're talking about, we still have a very heavy year in terms of gross borrowings ahead, because I think there is a lot of redemption pressure in the next couple of years that will add to borrowing. So interest rates from the point of view of the market will perhaps be under pressure.
Yeah, well, I think just a broader point on RBI, right? So RBI, as I said, they've been compliments. And I think what you're seeing clearly in the last 2 months is RBI correctly getting uncomfortable about the liquidity situation. And they've been trying to normalize policy through absorbing liquidity. Two quick comments to make. I think they'll be far more wary of injecting durable liquidity. So if at all any support has to be given, I think it'll be liquidity neutral in terms of operation twists. You buy at the short end, you sell you buy at the long end, you sell at the short end. I think the trilemma becomes more binding now. If in fact we do see large BOP surpluses, the RBI was comfortable intervening in the FX market and letting that liquidity accumulate. I think they'll be much less comfortable doing that. Now, of course, the BOP itself will change if the current account is widening and global financial conditions are tightening. But if we do see large BOP surpluses, I think when the RBI intervenes in the FX market, they will begin to think about sterilizing these operations by selling bonds. So I think the whole approach in 22, 23 is likely to change. I also think there are limits to, I think the RBI has been very clever about the VRRR strategy. There was an ingenious way to push up yields slowly, but there are clear limits to that. Despite the 3-day VRR, banks don't keep depositing 1 to 1.5 trillion at the overnight fixed rate window. They want to keep that. So I think limits have been reached on that policy, and therefore the next step will have to be more conventional reverse repo hikes. I do think that the RBI will wait the February meeting out, given the Omicron uncertainty. But from April onwards, I think two things we should expect. One is less tolerance for adding liquidity. And now that they've got some handle on liquidity, moving at least towards modest reverse repo hikes. Very last point I'll make is if I talk about slightly looser fiscal and monetary being a little bit of a substitute, not as much of a complement, you're exactly right. That in conjunction with global yields may push up the long end of the yield curve. But I would argue that if this is giving us 0.5% of GDP in fiscal space to spend on CapEx, spend on NREGA, right, create the conditions for future growth, 20, 30 basis point increase in yields is a small cost to pay. Monetary conditions are already very accommodative. Real rates at the short end are negative. So I would say it's a trade-off worth making. Spend a little bit more money on CapEx. RBI should focus on macro stability and inflation. And if it means a little bit of a hardening of long end yields, that's a small cost to pay in the grand scheme of things.
Fair enough. Sajjid, I'll leave it at that, actually. Thank you so much for taking the time to help us understand the economy, your thoughts on it, and how we should look at the budget up ahead. Thanks for joining us.
My pleasure.
Thanks for watching.